Well, hi there, and welcome back to another episode of Let's Talk Real Estate Investing. I'm your host, Sharon Vornholt, and I'm so happy you're tuning in today. My guest today is Charles Carillo, and we're going to talk about how to do what he has done, which is to build a successful real estate investing business. What are some of the components and the challenges? We'll talk about that. Charles is the managing partner of Harborside Partners, a real estate and syndication firm that's been actively investing in multifamily and commercial real estate since 2006. They have to date invested in over $150 million worth of investment property. And Charles is also the host of the Global Investors podcast, which I had the honor of being a guest on. He interviews professionals about investing in the U.S. in real estate. So welcome to the show, Charles.
Oh, thank you so much for having me on, Sharon. Yeah, great to see you again.
Yeah, we know what makes cash flow real estate investing so powerful. It's the passive income and the fact that you don't have to go to work every day to get this income, but it's also about freedom. And I want to talk about that today a little bit too. But first, let's talk about how you actually got started in real estate.
So yeah, in a short couple minutes. So I started. My dad's been a real multifamily real estate investor since 1984. So I grew up in the business, and his first property was a 6-unit, just a small 6-unit apartment building. So, and he went full time in real estate probably in the late 80s, early 90s. So my whole elementary school and middle school, and in through high school was 2 days a week. We were stopping at rental properties. At one point, he had probably had 100 units, most of them with one partner. And then he self-managed them, but he had like a small crew, I guess you would say, of superintendents that helped manage them. They were very close to each other, most of them were very close to each other, which made it very easy to do the management on it. And then when I got out of college, and his properties were really like D class. So like I would say D, C minus type stuff for the most part. He had some stuff that was C plus, but most of it was in that realm. So it wasn't something I was really interested in doing. And as he started getting more seasoned in his real estate investing career, he started buying better properties. And when I got out of college, it was something that he really made a note when I bought my first, now they call it a house hack, which was a 3-family property.
Right.
And when I bought that, he really just pushed on me to buy in better areas. You look at properties, and as a new investor, you're looking at returns, and you're like doing out numbers, and you're like, oh, I can make more money here and this and that, and or this will cover more of my mortgage, I guess, is the conversation when you're doing that house hack. And so that was very interesting, and it was something that I take now and talk to new investors about, which is always like, you can buy properties just for cash flow, but when you're buying properties that are better, you're going to get more of a mix of appreciation and cash flow. You know what I mean? The better properties you buy are going to have more upside. You're going to have more liquidity with them. You're going to have more people that want to buy them. There's not going to be people lining up your door to buy a D-class 18-unit building. Maybe in 2020, but in other times there won't be. And it's just one of those things that you just have to be careful with those properties. And then after we bought another 3-family and then a small mixed-use property and stuff like that. And then I moved to Florida in 2012. Through those 6 years of owning properties, I self-managed them all. And I had a couple handymen here and there, but mostly it was all self-managed, and put third-party management, moved to Florida. And since being here, we've really focused on larger projects. So it's been 2017, 2018, getting involved with syndications, and up until now.
That's interesting, because I know a couple of people that invest in D properties, and my question to them was, why do you want that many headaches? And he said that this investor was in South Florida, and he was very particular about his tenants, and he was very particular about providing them with a level of security and safety that they felt like they couldn't get in other places. So that was his jam. That's not mine, because I don't want the problems that come along with you attract a certain quality tenant. That's just, you do. And and I don't have the patience for kind of that nonsense. So that was never my thing. But I did want to ask you one thing, which is a question that comes up, whether you're talking about single family or multifamily, and that is self-managing your properties. See, my opinion is that no matter about the answer would be different if you had a 200 unit property. But let's say you're in small multifamilies or commercials or single family homes. My opinion has always been that you need to do it yourself first so that you can even know what to expect out of a property manager. Because how can you know what real expectations are if you haven't done it yourself and firsthand and you have firsthand experience? So what is your thought about that?
I totally agree with that. I find it, and there's tons of people now in the multifamily, I guess you would say, space that have never managed a property. They've never taken a tenant call. They've never been in that great conversation where someone can't pay rent and now you're working a deal or you're calling eviction. And you just it's really people management when you're dealing with it down to a level. And I was one thing, because at some points when my dad's supers wouldn't pick up all the rent, superintendents wouldn't pick up all the rent, we'd go door to door and pick up the rent.
Yes.
And you'd go into it. My dad had the old school ring binder with carbon paper. And you go to him, and he was very good at talking to people and how he smoothed it over. And I was in like fourth grade. He's smoothing over, taking rent from people. And it was just, it's a whole process. And you have to. So my dad now passively invests. He has some small rentals, but he mainly passively invests with us, and he loves that a lot more. Obviously, I don't think anybody will ever want to go back to active after passively investing. But the thing though is that you have to know because what happens if your property manager is telling you something and you're like, hey, when do you want us to send out, 3 days or quit notice? When do you want us to do this? How do you know any of that? You can read it online, but you've never been in that situation. How do we do cash for keys? Or if they suggest something and it's probably not going to work, well, that's something you have to look into. Or it's, dealing, there's many different parts to that, and knowing hands-on doing it by yourself. And it can be small. It doesn't have to be like you have to do like a 12 unit or something crazy by yourself. You can literally do a house hack and have 2 other units in your property, or just buy a 3 unit. And so you don't overwhelm yourself, and you can understand that knowledge. And obviously it's not going to be your best return on time. We all know this, but the education that you learn, it's going to be more helpful than really any YouTube channel or podcast you're going to listen to, because what you're going to learn is what works and what doesn't. And trying to find handymen to do work and all that type of stuff that goes with it. And then managing, access to units and all this kind of stuff. And you're not going to appreciate it from the property manager's viewpoint. Or if they say, oh, we're going to like renovate all these units in this much time, if you're passively investing into a deal, you might agree with them, or might say, oh, that sounds great, knowing that it's really not possible if you ever own a property yourself. So you get a whole nother education level when you've done it, even on a very small level.
You just cannot substitute anything for that education.
True. The experience. Yeah.
Yeah. So what are some of the biggest mistakes you think real estate investors make in this business if they're starting out, let's assume they're starting out with small multifamilies? I think not self-managing is one of those mistakes. What do you think are some of the mistakes that they make because they just don't know any better?
So a couple things. First of all, you'll hear me say this throughout. It's like buying better property. So if you're looking at property, make sure you are buying in better areas. And it can change by a block or two. It's dramatically. I've had tenants that would leave every year at one property, and I had ones literally 200 yards, 300 yards away that would stay for 10 years. And it's the property a little bit where they have an extra bedroom, but it's also the location. And it was just a better located property for them. So I would just say that, and if you really want to buy a property yourself and you don't want to self-manage it, you have to buy bigger. So you've got to buy something that's 12, 16 units, because it's just not going to pencil with the management, because you're going to be competing against someone that's buying that 3 unit that probably has 27 other units, and they're probably already paying 6% management fee, and you're going to come in paying 10%. So they can sharpen their pencil more than you can. But I would highly suggest someone to self-manage. I would highly suggest someone to look at buying better properties, possibly newer properties. Buy something, if it's your first time, buy something that is more turnkey. Don't get yourself into a value add. And when I say turnkey, I'm not saying go to a provider for it, but go to something that's been renovated And trust me, there's going to be work you're going to have to do to it. It's, you know what I mean? There's going to be a lot of stuff that was masked over. There's going to be stuff, but it's not going to be like, I have to go into this and I'm hiring a crew and I'm managing the crew and all this type of stuff that goes into it. You want something that, you know, windows have been done, roofs been done, these bathrooms and kitchens have been updated. You know, all this type of stuff is what you want to be going into from the beginning. And that is really what you want to do in your first one. You don't want to get into a heavy value add. And yes, your returns are going to be compressed on that because you're not adding as much value as maybe the person before you. However, if you can lock it up with long-term debt, and definitely that's the other part of it. Your first deal, don't get cute with short-term arms, you know what I mean? Adjustable rate mortgages, floating debt, get long-term fixed debt, even if you're in an environment right now where we have higher debt. Just do it. You can always refinance. And if it's a house hack, you're refinancing with no prepayment penalties and all stuff if you still live there. So that's really what I would say going into it is long-term debt, better areas, and don't take on a huge value add project for your first rodeo.
Yeah, that's great advice. That's also how you mitigate a lot of the risk when you're investing in real estate. Do you start off with easier properties? But as you and I both know too, that when you invest with partners, you're also mitigating some of the risk, which is what you do as you grow.
Right. Yeah. And that way, because you're going to have, depending on how you're investing, if you're passively investing or if you're doing an active joint venture type situation, you're going to most likely be partnering with people that are bringing resources and knowledge to the table that you might not have. So if you're JVing with someone and you're saying, hey, I'm finding properties, I'm going to put some money into it, but this person has, 80 units and they have a management company, they've got a great team, they flip properties on the side themselves, like all this stuff that you're tapping into. Because then at that point, because there's a lot of people in the town in Connecticut where my dad was investing and where I started investing, there'd be other contractors / real estate agents that would be flipping houses. And then they'd also have long-term rentals. So they had a crew for what they were doing. So they're fixing on a house in the morning, in the afternoon, they're going to some rentals and, fixing doors and changing faucets and stuff. And you're paying the same price for it. And that's where you're really getting scales of economy, because now you're saying, you and I will go into that neighborhood and say, we have to pay $40 an hour for a handyman. They might say I pay 20 because I keep these guys on every week and I don't have to. So they're just keeping them busy with tons of projects going on. So that's someone that you also are going to you probably want to buy from someone like that's already done the work. And then you're going on and really mitigating your risk. Now with your passive, or when you're in partnerships, hopefully you can bring something to the table and then really tap into them, because that's what passive investing is all about. If I passive invest in a lot of deals in real estate, and what I want to see in that scenario is that, hey, we have 4 properties in this market. We have a management company. We have 800 units. This is another 200 units. You know what I mean? So I'm riding right alongside them with everything that they built. So not only am I getting a deal on the property, you know what I mean? Like in the sense of like getting into the property and this is going to be a great investment, but now I'm probably getting a lower management fee per unit on the property I'm investing to with them. And then also I'm tapping into all their other networks that they have. You know what I mean? With 800 units, they probably have a great contractor deal with HVAC people, with the make ready people. I mean, they have so much scale in there that you're really tapping into. And that's really one of the moats of real estate when you're investing into, is like you have money, but also the relationships. And that's with brokers, but it's also with everybody else that goes along, right? With the deal.
Yeah, that is such a big takeaway, because as a small real estate investor, that's one of the biggest challenges you face, is finding contractors and not having to pay $40 an hour for something that should be 20, but you're stuck in this position, this spot where you can't afford a crew. You don't have enough properties yet. Someone told me one time, he was talking about single family houses, and he said, unless you have 50 units where you can scale, what you have is a painful hobby.
Yeah.
And that is so true.
Yeah.
So you talked about financing, long-term financing. How do you use, maybe I should back this question up a little bit. When we start out, a lot of times we start out with local banks, maybe your first property or something like that. You quickly learn that you can only do that so long, and you need private money to scale. until you get to this partners and the syndications and all of that. So did you use private money to scale early on from one step to another step?
No, I didn't. We used some private money to do some flips when I was back in Connecticut, but I really did like 3 or 4, maybe 5. My dad did a lot more flips himself. It's just my brother and I were at that time were running a small online business that was providing us with a lot of capital to buy real estate, and the flips was just it wasn't what my
Mhm,
real estate investing. I'm, like everybody else, you're getting the real estate and we think it's passive, but I
mhm,
knew it was going to be semi-passive because I'm managing myself or even more active. But the thing was that if I'm investing into something, it's much easier and much less risky to buy something longer term. If you're buying something and you're like, listen, I'm going to keep this for 5 or 10 years, much less risky than you going and buying something that, hey, I'm going to buy this in April and I have this crew that's hopefully coming in and I'm going to have to make sure this thing is sold by November or
mhm,
whatever your
mhm.
numbers are and dates. And that's a much riskier because there's a lot of stuff that can happen in that 6 months.
Yeah.
And that's something I found that you're buying for long term. The longer you hold properties, the less risky they are. And I kind of see that it's like even buying like you can equate down to like buying like a used car. So if you have
Mhm,
a car that has 50,000 miles on it and you could change it for another car that had 50,000 miles on it, yours is probably going to be less risky because you've had it for so many years. You know all the quirks with it, you know the
mhm,
problems with it. Same thing with properties. I had properties and I was like, everybody knows when you go to your property and you're like, that's got like, another year on it and that's got, 24 months on this
mhm.
over here. And
Yeah.
this, I'm putting money away for this, this furnace. And you know everything that's going on with it, and you know what has to be. You'll know those properties as well as like family members because you're there so
Mhm,
often when you're actively managing them. So that's
mhm.
something that you're going to know intimately, and you know exactly where the property is after so long because you're going to recover or uncover what's wrong with it really after your first 6 months of owning it. So.
Yeah. Yeah, and it's funny that I always think about the properties kind of like cars too. It's the known devil. You know what's wrong with it. Where when you buy another property, you touched on this before. So often they might put in the new major systems or the roof or something, and they put lipstick on a pig on the rest of it. And then you slowly start to uncover as you own this property what they didn't do correctly or what they should
Right.
have done with it. So it's kind of the same thing.
Mhm.
I wanted to segue a little bit here and talk about some of the critical parts of building a real estate investing business. Transitioning over from I'm the guy or the gal who has a handful of properties to really start to think about growing an actual business. And the one thing that always comes to mind is your team and
Mhm.
getting your team on board with your company vision, with your goals, and all of those things. Because you could have a great team, like you could have a great contractor, but if he works for your company, but he doesn't buy into your overall vision and your growth plan, then you have a problem. But that's particularly true with your team. So where do you start with your team and tie that back with the goals of the company?
So if you're not buying like one-off properties and you're actually going to make a business and you're buying properties actively, number one, I would make sure that your strategically like geography is correct. I mean, it's not going to work if you're driving 45 minutes to a 3-unit property.
Yeah.
It will work if you drive 45 minutes to a 60-unit property. But the thing though is that you're starting, no one, you're not really buying a 60-unit property. So the thing though is that if you're buying properties, strategically try to buy them as close as possible. That's going to make your management hassle. I mean, just it'll pay dividends down the road. And when you
Mhm.
sell it, you're going to be able to sell it and get a premium as well because the same person now you can sell and they go, well, I don't want 24 units that you're selling in this portfolio. Yeah, but I want to buy like, I want to buy like 124. Correct. But these are all within 4/10 of a mile or something of each other.
Mhm.
You know what I mean? So you can handle this very quickly. You can keep a, storage here. You can do this, all this kind of stuff for all your parts. So I think that's one thing too, is have that set up number one. And when you're buying, so keep that in mind because you might find a deal. But the thing though is that it might not work for what you're working on, for what you're
Mhm.
doing. And it depends on your team of how much time you have. Because what I used to do when starting off, and there'd be like stuff that didn't need to be done right away, but had to be done probably I'd want to do in the next couple of weeks. I would just keep a running tab, a running list, and then I would hand it
Mhm.
to, I'd get a handyman in there and for like 4 hours or 5 hours on a Friday or
Mhm.
whatever day it was. And I would be, driving around, I'd be getting parts. We'd go to Home Depot, we get all the stuff we need, all that type of stuff. You know what I
Yeah.
mean? And it would get done. And this is when I was in my 20s. I wouldn't suggest anybody now to do it. But the thing though is that when you're doing it, it was something that I would do it now a little differently. Is find someone that can work with you, that can like spend time with you or on your projects,
Mhm.
properties every week. I would even get them like credit cards for what you're doing. Just really remove yourself from it. And
Mhm.
then it's going to be, these properties at best are going to be semi-passive if you have a management company. If you don't, and you're the management company, they're going to be a little bit more active. And
Mhm.
so, which isn't the worst thing, but it's also depends on someone calls in and has an issue. Okay, I can take a call anywhere in the world. But the problem is who's being dispatched or who am I sending out to do that? And
Right.
are they on my team where I'm giving them keys? Or is it like, hey,
Mhm.
the person, you know what I mean? The person has to be there to let them in. Completely different kind of mentalities. Because when you're leaving keys with people, they're really on your team, as you were saying. And I mean,
Mhm.
that's really where you're going to be able to grow. So
Yeah.
they can schedule time out with you every week and you're paying them no matter what it is. And now that's the time when you can, whatever has to be done can get done. And then when you need more time for them, they can bring someone else in there. You know what I mean? You want to turn an apartment. I don't want to
Mhm.
wait a week to do it. Hey, bring one of your friends with you, and or we can get this done, and
Yeah.
I can get this thing re-rented. So, you're also using them if they're handymen. You're using them for a lot of contacts to licensed professionals, which is key. You don't want to be. That's one downfall with people is that you don't want to be paying like yellow page pricing for stuff. So it's if you handyman is so critical. Have to have that when you're working in multifamily. It's so important. Doesn't matter what class you're in, you need to have that. Next person for your team is you start making contacts with these licensed professionals. You don't want to be paying $250 an hour for a plumber to come out. You don't want to be paying $250 for an electrician to come out. So these are things that you need to find, and you need to have them on your team at some point, so you can do these projects and cost efficiently.
Yeah, I love that yellow page pricing.
Yeah.
Make a note and stick that up on the wall. That's a term everybody should use. Yellow yellow page pricing. Um, I have a friend who's a real estate investor, and you've mentioned getting rid of the job completely, handing the keys over to someone else and having them go do it, as opposed to in the early years when you did it. So my investor friend said, somebody that you would know, he told me one time we were doing a podcast on entrepreneurship, and he said my team came to me and said we needed to have a meeting. Rather than I go to them, they came to me. They told me I was the cog in the wheel, that I
Mm.
needed to trust them. I needed to offload the entire job, that by having everything come through me, it was
Oh.
making the process hard. But that was the term he used. I've never forgotten that. I was the cog in the wheel. So, but that's hard for entrepreneurs sometimes.
Yeah, but it's a great team that person had. If they were
Mhm.
telling you, they're giving you feedback on your business, and that's great. But yeah, it's really important because you're not going to be able. That's the thing with the property manager is that property manager is going to allow you to scale. And
Mhm.
the best part about bringing a property manager on is if you have a number of units or if you have an aggressive acquisition plan. So I'm going to bring on a property manager now, not going to make much money on these properties for the first 6 months or so. And I have some sort of, hey, when I hit 35 units, they're going to drop my rate this much. And I hit this many. And you have some sort of tiered plan, progressive plan that you're working on that you are able to kind of base your numbers on. And then that's where you're going to start getting scale. But it's also when there's an issue, they're calling the property manager. Property manager doesn't have to,
Mhm.
then I get the call from a property manager when something starts getting to four figures. You know what I mean? Hot water heater, it can get changed. It's going to be,
Mhm.
X amount of money has to be done. And you don't have to tell me about it. Obviously, we know you're going to go get the best price. If it's 40 gallon, you're going to put 40 gallon in. If it's 30, you're not going to put 40 in. All these type of things. And
Mhm.
you have to get done as soon as possible. I mean, you have tenants that are paying you for this. And so it's that goes without saying, and that's the great part about it because there's a lot of stupid questions or stupid things that
Yeah.
might come to the owner, like what's probably happened as the cog, and he had just had to say yes, and you're like, well, I don't even need you. I could have gotten this all done this morning,
Mhm.
and they're probably working on another business or have other business too.
Well, and you put it in there. One of the things you have to develop parameters, like you
Mm.
said, if it gets into four figures, they need to call me. So, but you put these parameters in place, and then if it's below this certain amount, they can just take care of it. Like you said, the water heater or whatever could be in by the time they got you to respond after you did 3 podcasts today. It's so it's a waste. It's a waste of time. It's a waste of time and money. But it's hard for entrepreneurs in the beginning to turn things over, and then when you do and you realize you're getting your freedom back, gosh, it is so freeing. But it all comes around having a team that you could trust. And I wanted to ask you about the property managers. So you have a property management company that in your geographic area that manages all your properties. Is that the way it works?
Yeah. So earlier this year, all of my smaller properties we sold in a portfolio. So up until that time in this area, because I sold everything we had in Connecticut it was literally within a half mile of each other. But how I had structured is I had purchased properties in this geographic area when I was self-managing them. And then when you'd find deals, you would make sure that they kind of fit in there. And then you start knowing all the people in that area too, like landlords. You're not going to know
Right.
tenants, but landlords in that area, and you start seeing properties that start getting renovated. You start stopping by and asking them, hey, what are you doing with this property? Every person flipping a house loves to save on a realtor commission. So you start networking in that fact. And then you're like, well, there's a duplex across the street. I don't want a duplex, but it is across the street. And it's easy to manage. You know what I mean? So that's the type of mentality you can have going into buying the properties. And then when you put it, at a certain point, you put it with the management company. And I think we started like maybe at 12 units or something with our management company. And that's what I would suggest for other people too. And at that point, you can, now it allows you to start scaling. So it starts to allow to spend more time. It's like hiring an assistant. You're spending more time on higher value things. You're not driving around, and you're tapping into their network. I mean, the property manager I had a handyman that was 8, 9, 10 years full time with him. Then he had another one too. And so like you have relationships I never had. The other thing too is we talk about all about the properties, but one thing I found with my first property manager was that the connections that they had into the city, which is another big thing. You don't want to, you personally, you want to find someone that's been in the city, in the geographic area that you're in, municipality for 10, 20 plus years. And that's who you really want to put your properties with. Because the thing was, on one occasion, just a quick example was that these were older properties. They had grandfathered in stuff from that, the fire department grandfathered stuff in that couldn't be changed. You know what I mean? And with that being said, they came one time and they're like reviewing and they're like, listen, these are the things that need to be changed at this property. This needs to be changed. This needs to be changed. The whole laundry list. So the property manager is like, listen, he told me, he's like, let me talk to him again one more time. If he doesn't have it, I have the cell phone number to like the marshal. So that is, or the chief. So it's like, that's really, I don't have the cell phone number to the chief of fire. So it's like that's something that you're paying for too. That's included in there. That this person can pull cards that you can't, and that's another thing too that you want to see, that someone's been in there so long. And they also, if you tell people about different contractors, so if they're not my property manager, your property manager is not going to do a roof for you, correct? But if I tell them, hey, I got a quote for 17,000, that's about right, blah blah blah, and he goes, well, I wouldn't, if I brought something to him, like, or if I need something done, they're like, these are the contractors that I would use. If they're busy, then you would have to find your own. And so you're tapping in for more than just taking phone calls at the quintessential 11:30 p.m. at night for the toilet. They're doing a lot more than that. And that's what you're paying them for. So you got to look a little deeper than just, hey, I'm going to charge you 7% and we'll handle this. And we have a handyman on staff. You want someone that's, you know what I mean, that's going to be in there, that if I have an issue, I can lean on this person to use their contacts for getting it resolved as, let's say, effectively as possible.
It's funny that you mentioned those examples, because both my daughters are property managers. One manages a very large, she's an on-site manager for a big property for a man that has properties around the country. So she manages this property. The other one manages, I don't even know how many, more than 100 properties, but she she talks about, both of them talk about the relationships they have with the local code enforcement people. You've got them on speed dial because there are things, like you said, that have been grandfathered in. One of my daughters just had that whole issue with the fire marshal on a building that didn't have, it was something to do with sprinklers, but it had been grandfathered in at the time. And now they've got a brand new fire marshal who's been there 5 minutes, and he thinks it all needs to be ripped out and done. But Debbie said, don't worry about it. She's telling her boss, don't worry about it. I'll call the real grown-up fire marshal and we'll get it all straightened out. But yeah, those relationships are golden.
Yeah. It's the same thing with dealing with permits. We had a couple permits when selling that weren't closed out, and that was all my fault. I should have been checking, make sure these permits were closed out. But had one one of the mechanical one of the people down City Hall that handles those type of permits. And it was difficult, but I had to do it between the contractor and get this all situated, and had to do it with the property manager. And they were able to, you're using, so it's so important to the different things that come up. It's really not just dealing with tenants and keeping the property rentable. There's so many different parts, especially with municipalities and government. I mean, they don't care that you can't rent it. They don't care how much it costs. They leave their office at 3:15. I mean, so it's like it's very difficult to work with them. So having as much pull in these areas is so important as a property manager.
I read in your information somewhere, and it's really this, I really wanted to know this before we finish out the show today. You had written down your list, developing your list of non-negotiables. What is on your list of non-negotiables?
This is really just, I would say mostly on non-negotiables. These are just things that I guess you've done, or maybe it's a mix of mistakes you've made and plus things that you'll never do again. So it's it gets longer as
you go on. Yeah.
But it's really just I would say there's, I'm really not buying any properties built prior to 1980 anymore. That was for me earlier lifetime. And I'm buying properties that are newer. I'm avoiding all the stuff that goes in with all properties pre 1998 or 1980. And, you have the asbestos and lead and all that stuff that goes with it. Aluminum wire and all this type of stuff. So these things that you really avoid, it makes your life less of a headache. It makes your manager's life less of a headache too, because they're getting less things signed and they have less liability. Other things too is I had, I would never buy properties if I had them written for certain areas that I was investing into. So I'm like, I'm never going to buy a property where they're renting apartments under $700 a month or something, whatever that number is. These are things you'd have to do for your own area, because you're in a certain area. You want to make sure, like you said, you're with a certain clientele. I want to be buying properties that are in areas that aren't C+. They are C+ and above. Really B- and above, and the quality of the property matters, but that's what you can do work on. You can't really fix the neighborhood. And then you're definitely not fixing it if you're doing any type of short-term hold. If you're doing it yourself and it's some opportunistic thing where you're keeping it for many years, but I think most of them would be, it's just a list of mistakes I've made in real estate and how I'm not going to I'm not going to make those mistakes anymore. And to make sure that every person should have that no matter what their business is, even if it's not real estate, stuff that you're not going to do, stuff that you're not going to waste time on. And everybody's made mistakes in learning, and it's really just checking back with it, because, if you had a poor situation with something years back and then it happens again, you kind of see a pattern there, and you have to stand back and look and make sure that you're not getting involved with it again. And just anytime I've really had issues. The other thing too is making deals on people getting into units. I've only done it a couple times, but that's another thing too. You want to make sure everybody has all their funds up front. There's no stories. You know what I mean? Everybody's got a story.
Yeah, everybody's got a story.
But you want to make sure that those stories are not coming back to not having a job or proving income or some sort of weird, you're paying me 6 months in advance for rent on a property that's not in, New York City or Boston, you know what I mean? Where the clientele might do that. You're, you know what I mean? So no one prepays for apartments in good measure in a C-class property for a year.
Mhm.
And then it's just different things, you know what I mean? You have to be using your gut with going with it. So I think everybody should make out their list of non-negotiables, and it'll go as you start thinking about it. You start adding stuff to it, you'll start finding stuff, and you can do it as a personal and then also in your business.
I love that you mentioned area specific, because for me, that was, I had non-negotiables. I never really had a thought of it as having a list, but there were the way things are in one area. Well, let's B minus C area. It might be vastly different in a D area, but I love the part about nobody prepays in those type of rentals for 6 months. They just, if they do, it's not income that's been reported to the IRS.
That's correct.
So, yeah. So that is great information. Charles, it's just been a pleasure having you on today. And folks, be sure to check out the Global Investors podcast. And he has a free passive income investing guide. And you can learn more about the Investor Club. And I'll put the link there, but it's over at Harborside Partners. And what's the best way for folks to get in touch with you if they want to reach out to you, Charles?
Yeah. So what you can do is if you're interested in setting up a call with me, so if you're looking for the guide, you can just go to Harborside Partners, and I send out a link to everybody that gets our guide to schedule a call. So that's probably the best way of doing it. And harborsidepartners.com, and every page will have a link or has the form for getting the passive guide. And then I'll send you an email with a link, and as I do for every person that signs up for it. And hopefully we can set up a call. And I mean, it's interesting if you're actively or passively investing. I mean, there's a lot of information in there for whatever your mindset is, because I find with a lot of people that passively invest, they're also somewhat of a active investor in many situations, not all of them, but in many situations. So they're just diversifying, which I feel is a fantastic way of going about utilizing passive investing in your portfolio.
Yeah, and you can check out how you can work with Charles there in that call. So if you're unsure about the direction you want to take in your business, maybe you are an active investor, maybe you think you can't invest passively, have a conversation with Charles and find out. But regardless, go over to his website, take advantage of his resources, reach out to him, and go from there. Well, thanks again, Charles. Yeah, it's been a pleasure.
Thanks so much for having me on today.
And thanks to all the listeners that come out week after week. I do appreciate it. And I also would appreciate it if you would leave us a rating and a review over at iTunes. So I will see you all same time, same place next week. Bye for now.